Okay, good night. Today I will present the presentation for financial management and policy. Basically, I have the assignment to assess the case study from wind power, and I've already make some calculation with the financial model, and also creating the analysis of the financial sensitivity. Okay, so first, okay, from this case, from wind power, we have some key assumption that the total installed capacity is 100 megawatt with the 50 turbines times 2 megawatt each. And then secondly, the project life cycle is 25 years and standard for wind farm operation. Right? Okay, and the third is project financing is 100% by equity financing for the investment. And the fourth is the annual operation cost is adjusted based on the inflation by 2% on operational scaling. And also the fifth, the contingency fund, it's already set at the 10% of total capital costs to cover the unforeseen expenses. Okay, and then the next is the input assumption that from this case study that the investment cost is totally 181 million 500,000 dollar, and which has consists of wind turbines for 120 million dollar, and foundation and civil work to 20 million dollar, and then electrical infrastructure the 10 million dollar, and grid connection 5 million, and other project costs like land acquisition permits, environmental assessment like AMDAL or CALPEL for 10 million dollar, and contingency is 16.5 million US dollar. And also we have the operating cost with totally per year is 5,400,000. And also there are with the consist from the operating cost is operation and maintenance with the routine maintenance inspection parts replacement almost a 2 million dollar per year. And then land lease payment with the annual payment 1 million dollar, and then the insurance for the premium risk. This is a 1.5 million dollar per year. And then fourth is the transmission and grid fees. The toll fee, like we said, like toll fee is 700 million per year. And then the last is administrative and GA, general expenses. It's almost 200 thousand per year. This is for salaries and legal fees and other for the entire plan itself. Okay, this uh uh I've been create the calculation from the Excel from the financial modeling. This is the income statement and cash flow. I've set the basically on the operation year until 25 year, and the first, okay, I will annotate it. Okay, the capex has been released at the first day is 180.5 million dollar, and the revenue will be generate for 24.09 million dollar per year. And then we have an inflation rate for 2%. This adjusting for the fixed OPEX. But previously I've been already calculated the 5,400,000 from each from the zero period from here, and then it will be increasing up to percent by at the first year, so it will be 5.5 million, and then goes up until 2049, 1 February 2049 or 25th years is almost $8.9 million per year. Okay, and then after that, from the OPEX, uh, we create the uh, depreciation on asset. This have been set for 7.29 million. It's divided for declining each 4% each year until the end of the contract. And then we have the some EBIT from EBIT earning before interest and tax is from the first year is 11.29 million, and the last period of the contract is 7.9 million. And also we have some net profit after tax because the tax uh, already divided. It's from 9 million at the first year, and then the last period of the 25 years is 6.3 million. Okay, and now we move to cash flow. Because the assumption from the case is uh, the shareholders need apa needs the required return is uh, uh, up than 6%. So I put the discount rate itself is 6% because they already expect higher than 6%. Then you have the totally operating cash flow in here is 37.6 million point two US. And since beginning, we at the first year we have a $16.2 million, and then we have a discounted cash flow in here because it's lower because it has already been discounted 169 96.5 million. And at the first year, the discounted at the cash flow is 15.3 million US dollar. Okay, so in here I have minimized the table from uh, from the 5th year until the 21st year, but the recent parameter apa the output parameter will be explained after this. Okay. Okay, this is the outcome parameter. We have some net present value is positive at 15 million US dollar, and have the IRR is 9.82%. Because basically on IRR equity, same with the IRR project, yeah, because there are no such a loan payment or anything else from the third party financier. This is a fully equity. And as what I said before, the discount rate is already 6%, then the shareholders need uh, more than as their expectation to this project. And the cost cash flow from the accumulated cash flow is which uh, get into the payback period is 12 years. So the minus is already being positive at the 12 year 12 or 12 to 16. And then the discounted payback period as the I calculate from the accumulated discounted payback period, which has a uh, minus value from the first year until the 21st year, and then after that becoming positive value for the uh, discounted cash flow. And then the and then the and then uh, this project have a profitability index 1.083 times. It means that the net present value divided with the accumulated cash flow totally, and then after that, after we have some the outcome parameter, NPV, IRR, and etc., we need to know what is the main object for this project that can be infected. I mean, the can create the big impact to this project from which side. So we set from here. There are some description of parameters. There are from capex, fixed opex, tax rate, inflation rate, and revenue. So we have already based the value from the NPV, and then we create the uh, trial and error for each parameter. If like a plus 10%, and if the what if we put the minus 10% from the what have been locked by the parameter. So it's like a if we put the capex now here is best case is 181 million, and then we put at the 10% up, then we have some value at NPV minus $1.1 million. And if we put the minus 10% of the capex from 181 million, then we have positive uh, increasing the value of NPV from 15 million get into 25 million. And here's the value which has a big impact from the percentage, which has a minus very big is revenue and the capex. Okay, so if we put in the some diagram like this, the maximum impact from the percentage has been picked by the revenue. And then secondly is capex, and the third is fixed opex, and then lastly is tax and inflation rate. Okay, so in the conclusion is based on the analysis, the project can be considered to have a green light to go for the following reasons. Because there's a 100% fully equity financing. It has a result, the IRR 9.82%. This is the equity equity investors expected return or of 6%. That this is indicates a positive investment outlook. And the second is the positive NPV is 15 million US, so that the project investment return are not negative, assuming the capex and opex and other parameters still same, remain unchanged. But we have some crucial to pay attention to the sensitivity analysis result. The most significant factor affecting the NPV is revenue. If the revenue drops by 10%, the NPV could turn negative, falling to the minus 12.4 million USD. And another, the technical capex spending is also critical factor. If capex increases by 10%, the NPV would increase by until the minus 1.1 million US. So both these factors should be carefully monitored and as the project progresses. And lastly, it is worth considering the possibility of including the bank financing of this party financier as a part of the project, funding the potential improve to the equity IRR and make the project more financially viable. Okay, so that's all from the my presentation of the financial analysis from the wind power for the examination. Thank you very much.